Hi, everyone. Welcome to the show. I'm your host, Jason Nadek. If you could go back in time, what wisdom would you share with your younger self? It might be to travel more, take risks in your career, or be more honest about your feelings. There are so many possibilities. But when it comes time to our finances, many Canadians have the same wish. In an online survey, a whopping 70% of respondents told debt relief consultancy Bromwich and Smith that they wish they had started investing earlier in life. It takes two words to explain why: compound interest. For example, let's say a 15-year-old invested just $100 every month for 35 years and earned an average return of 5% per year. They would have about $110,000 by the time they were 50 years old. But let's say they started a little later in life at 30 years old. They would have just 40,000 by the time they turned 50 years old. Simply put, the more time that investments have to grow can make a massive difference in the end result. It can pay to start early and stay consistent, even with a relatively modest amount of money. So, parents might want to help their children establish a habit of investing early in hopes of giving them a financial head start in life. But as most know, it can sometimes be tough to convince children to understand and care about money management. Well, we're going to discuss some ways for parents to get their kids invested in investing, pun fully intended. Joining us is Michelle Hung, founder of the Sassy Investor. She's also the author of the book Investing for Teens: How to Save, Invest, and Grow Money. Michelle, great to have you back with us here today.
Thank you so much, Jason. I'm really excited to be back. I certainly wished I started investing when I was 12, 13 years old, but I can only blame my parents for that. They didn't know how to do it themselves. I certainly had no idea what it meant back then. So hopefully, for the parents watching out, they're joining us today, you can help get your teens started with investing and give them a little bit of a head start in life.
It's definitely a sentiment that I share. You wish there was somebody to learn from, or even something taught in school, but it's just not. So it's
Mhm.
something that this opportunity to learn from this discussion is going to be a great one. So before we get our kicked off here, what's one of the key takeaways that you're hoping to impact to teenagers and their parents through your book?
Basically, just give your teen another option to do something with their money besides spending it. So if they're given allowances or they're earning money through a part-time job or a summer job, get them to get in the habit of putting a portion of it away into growing their money, not just spending it all because, yeah, they've earned the right to. But if you give them other options, and that includes, teaching them how to grow it. When they eventually come across a larger sum of money later on in life, they would have gotten into the habit of saving and investing a percentage of it.
I've got a teen here at home as well, so I'll be taking close notes to put some best practices into work. All right, now
Mhm.
before we get into our conversation, I have a trivia question for the audience. What percentage of parents are investing for their children's education using a registered education savings plan, or an RESP, according to data from Statistics Canada as of 2020? Now, we'll reveal that answer at the end of our conversation, so stay tuned. All right, let's get right into our conversation here. So, we've established that kids have the benefit of compound interest over time if they invest early, but it might be difficult for parents to convince their children to care about their financial situation that might be many years into the future. What do you think we can do to motivate them?
Of course, every child is different, and an approach that works with one might not work for another. So, of course, that's just life of a parent. That said, I think appealing to a child's or a teenager's desire for a fun, independent, and self-fulfilling lifestyle can help them get interested in the idea of investing. So, for example, in my book, I mentioned meeting a woman in her 20s while on vacation in Hawaii. She actually moved to Hawaii because she wanted to surf. And she explained to me that she was able to do this because her father helped her invest when she was really young. And her portfolio grew enough by the time she became an adult to support her lifestyle and that decision that she made. More generally, teens tend to want to move out of the house at the earliest opportunity. And, they don't like their parents telling them what to do with their time and money. So investing can give them a way to earn their own money and become independent financially. So just like, sharing stories like that and just letting them know, like, hey, if you start earning money on your own, the more money you have, the more options you have in life. With younger children, they tend to be motivated by physical rewards like toys, for instance. So, framing investing as one way to help afford the toys they want can be another source of motivation. And I think setting clear saving and investing goals can be a powerful motivator for a child or a teen investing for the first time. So, for example, investing for post-secondary tuition, a first car, vacation, a video game. I would say start with something small, like a video game, because once they're able to attain an outcome like that, they'll know what it feels like, what it takes to save money for a goal. So start with a small goal and then make the goal a bit bigger and bigger. And of course, without a goal that's clear and attainable, the effort it takes to save money can feel aimless and a little bit daunting. And it may be difficult to stick with the plan.
That makes a lot of sense. So we're really kind of focusing on what's in it for me from your child's perspective, and kind of getting away from that instant gratification of like just spending your money right away, but saving it up and achieving that goal. So that makes a lot of sense, Michelle. So how would you suggest parents approach these topics of investing with their children in a way that might be more relatable and can help get them involved in building, solid investing habits?
I think one way to frame it is when you're investing, you're making a company rich every time you buy something. And as an investor of these companies we buy things from, we're entitled to the profits that these companies generate. So investing is essentially getting a lifelong discount on everything that we're buying already in an indirect way. So let's take an example like buying shares in a clothing company is a way for the child to earn a very small piece of the profits that company generates. So, in some sense, the investor is helping themselves by purchasing those products. As for younger children, I think the idea of savings jars can be helpful. Parents set aside, for example, they can set aside three empty jars for the child, one for spending, one for saving, and one for investing. This can be there can be a digital equivalent of this as well. But what happens is the child will divide the money up that they earn into those three jars, and they can only use the money in each jar for for their intended purpose. This may also help a child understand and normalize the idea of saving and investing without having to sacrifice the near term enjoyment of spending money. But this also allows them to see physically their money jar grow and fill up.
You get a visual example, but then you're also
Mhm.
getting what's that gratification, being able to spend some of it kind of along the way. So yeah, I can see how that could work. Some parents might feel as though their child doesn't have enough money to invest. Yet you write in your book that the amount of money someone makes is less important than how they spend it and how they save it. Why do you feel this way?
It's not necessary for a child or teenager to have a lot of money to invest because they have the benefit of compounding over time. So, for example, consider setting aside, $50 a month for 10 years, and let's just say they earn a 5% rate of return average along the way. This would grow to about $3,400 in 5 years and about $7,700 in 10 years. This money could be put towards education, a first car, vacation with friends. Okay. And that would be rewarding in the end, but probably not that difficult to save for along the way. So the money you save is more important than the money you make. So if, for example, if you earn $100,000, but you're spending $95,000, you're no better off from a savings perspective than someone who earns $10,000 but spends $5,000. I've seen a lot of high income earners spend themselves into debt, no savings, they accumulate debt. Um, and at the same time, I've seen a lot of low income earners save a lot of money. So it's all about having the discipline to manage expenses and diligently save and invest. If one can't handle managing $500, they're certainly not going to be able to handle $50,000.
So start small, start early, and start often. The power of compound interest is just one of many important concepts for young investors to understand. To find out more about some of the others, make sure to check out our video course, Intro to Personal Finance, which is available on the Learning Center and on our YouTube page. Budgeting can be an important part of getting ready to invest. In your opinion, what budgeting approach might be easiest for a teenager to adopt and maintain?
In my opinion, a 50-30-20 budget might be effective for children and teens getting ready to invest. So basically, the breakdown is you spend 50% of your earned income on needs, 30% is spent on wants, and 20% for savings and ultimately investing. I think the 50-30-20 works well because it doesn't set an unrealistically high savings goal for the child. You're not forcing them to save 50% of the money. So it just eases them into the idea of putting aside money. And especially when they may say earn, like very little money or rely entirely on birthday, holiday gifts for their income, kids want to be able to spend some of their money they earn as their reward. And so, regardless of the specific breakdown, I think normalizing the idea of automatic savings as a fixed expense can be really helpful for instilling money management and investing habits early. This regular savings can later be transferred to an investing account and allocated to investments that the child helps select, for example. Another approach that I think can work well for some children is an allowance system. This sets the child sets an amount of money per week they're allowed to spend, such as $50. For example, and they can't exceed it. Separating savings or investing money away from their spending account can really help enforce this budget. And this approach may help some children learn to live on their budget and figure out ways to stretch their dollar, delay gratification until the following week, which can be a very effective habit. It's just one of those struggles that a lot of us adults have today. So teaching a child to do that at a very young age will be very helpful for them as they grow older and come across more money. The digital equivalent of this allowance approach would be, could be achieved using prepaid credit cards. You just load a certain amount every week towards your prepaid card, and that's the amount that you're allowed to spend for the week. You can also have like a designated checkings account for spending only.
I like the point that you made there about involving your children in the investment decisions. So ultimately, we're responsible for the, let's just say, their RESPs, to manage those and make sure it's in a good place for when it's time for post-secondary education. But help bring them along in those investment decisions and discussing it with them, I think, can really make things real for them, and could be a key tactic. We can sometimes get discouraged when we fail to stick to our budget and feel the temptation to abandon it altogether. What suggestions do you have for fighting that impulse?
It can be natural to feel discouraged when we fail to stick to our budget, and it's something that's just super common for a lot of people. That said, I think setting up systems that automate money management as much as possible can help avoid cases of either forgetting to set aside money for savings and investing. And as mentioned before, separating your savings from your spending account is key. So, for example, a teenager could set up automatic transfers from their checking account to their savings or investing account the day after they get paid from their part-time job. So there's no like, oh, I forgot to set aside money. It's automatically done. For a younger child, as an example, they can do the same after they get their weekly allowance. So you want to remove the immediate accessibility of money so you make it more difficult for yourself to spend that money that you're supposed to be saving.
Those hurdles to accessing the money can really kind of remove that immediacy of the impulse that you're feeling. That makes good sense. And for those in our audience who want to learn more about how to go about automating the investment process, watch our webinar, Three Ways to Automate Your Investing Approach. You can find it in our Learning Center on Webroker as well as on TD's YouTube page. All right, so moving on to the next question. Now there's a lot to learn about specific investment products and the role that they play in a portfolio, far more than we've got time to cover here in our conversation. But what are some of the fundamental investing concepts that you think a child should understand before they get started?
I think some of the important concepts to understand and broad strokes are first one being diversification. It's the idea that holding many different types of investment products across various geographies and sectors in the economy can help limit the risk of a major decline in your portfolio. To put in simple terms, don't put all your eggs in one basket, because if you drop the basket, then all your eggs could break, and we don't want that. The second thing is volatility, which is the rate of fluctuation in a stock price movement over time. So stock prices, they go up and down in the short term, long term. That's a normal feature of investments, because if stock prices didn't move, then there would be no opportunity to make money. So that's all part of it. It's normal. And then third is risk, which is the chance that you might lose a part or all of your investment. So consider that there's no such thing as a free lunch when investing. You must take some risk to earn a return. If you take no risk, you're not going to earn anything worthwhile. And also, it's not necessarily true that, higher risk means higher reward. This is just a common misconception. Some types of investments, like stocks, tend to be riskier than bonds, for instance, but it's important to evaluate each investment on its own merits. I would say it's important to understand how an investment product might earn an investor money before a child or teen chooses which one to invest in. It's important to take the time to talk through the potential risks and benefits of an investment with your child before making any decisions.
Makes great sense. And like we've already covered, children do have the benefit of time. So even if we're not taking on the riskiest investments on their behalf, even something with a lower risk reward profile is the benefit of time is going to be working on their behalf. All right. So some teenagers might feel as though investing is inherently high risk and they might be hesitant to lose their money. What would you say to help some of them get more comfortable with the idea of what can be called reasonable risk?
I think it can be helpful for a child or teen to take an investor profile survey before they start investing. So it's essentially like a risk tolerance quiz, a risk quiz. This survey or quiz will help them determine what level of risk they might be comfortable taking with their investments and which sorts of investment products might be appropriate for them given their risk tolerance and their goals. And it's important for an investor to periodically revisit this survey because goals and needs might change over the years. It's not one of those things that's like one and done. And I think it's really helpful for a young investor to keep a long-term focus because they likely won't need their investment money for quite some time, which means they'll be able to tolerate higher risk investments. That means that short-term changes in a stock or a fund's price won't really matter to their goals. And of course, provided the investor still has confidence in the rationale for that investment, it's really important to help them stay on track, stay invested, and not react based solely on the short-term price movement of their investment. So also consider that taking too little risk is a risk in itself. The risk that your money won't grow. Earning a higher rate of return will mean the compounding works faster, your money will grow faster. And that said, each investor needs to be comfortable with the amount of risk they are taking with their investments. So keep that in mind when discussing that with your child and help them understand their decisions. Another aspect to consider is that a young investor who intends to invest for a very long time, say 25 plus years, has a lot of time to recover from any declines their investments may experience along the way. So for some investors, this might mean they can feel confident taking higher risks with their investments.
That makes a lot of sense and clarifying that risk is not an all or nothing type of thing. There's many shades of gray. All right, so researching investments can potentially be a very time sensitive and complicated process, but of course, it's very important. In your opinion, what could a teenager do to make the process a little just a little bit more straightforward?
In my opinion, one place to start investment research could be with, brands and hobbies they enjoy to get them interested in the process. So I do like the quote from the famous investor Warren Buffett, who said, invest in what you know, because it may be easier to research something we already understand on some level, and we may be more motivated to continue learning about it. So, for example, if a child is really into video gaming, they could start researching video game design studios or hardware makers. But keep in mind, it can be expensive to buy individual stocks, especially if they're starting out with a little money. So it may not result in a very diversified portfolio. So another consideration could be, investing in diversified funds that hold many different assets. This may be a way for the child to get more familiar with the benefits of diversification and the various geographies and sectors they can invest within it. And researching funds can also be a way to introduce the child to the concept of, management fees, which are somewhat like a subscription fee. They may have encountered with products or services they use in everyday life, like, Spotify or Netflix, who pay, a subscription fee to use those products, right? So management fees are paid to portfolio managers to manage assets on behalf of investors. And I think another approach to consider would be learning about dividend stocks. The concept of dividend payments is in some ways like an allowance that a child might receive, and therefore help them understand the concept behind dividend investing. Dividends are great for everyone because, we get to see that cash tangible reward for investing in those stocks, and those dividends are paid out from the profits that the companies generate. So the child may also find motivation to continue investing, as they see their dividend payout, but also they'll see the dividends increase as they buy more shares over time.
Tactic of investing in things that you know or things that you're passionate about. I don't think it just needs to be pigeonholed just for teens as well. It would work for all of us, regardless of
Mhm.
our investing histories. It's just that that level of passion is going to help you focus on just being engaged with your portfolio, which can be a healthy strategy. All right, now we know that social media is a big part of many teenagers' lives, and it really can heavily shape their perspective. What do you feel they should consider when they're consuming investing content online on social media?
So there are many examples of uninformed influencers pushing all sorts of, unsound financial advice on social media. For example, there was a lot of, those a lot of influencers pitching day trading to make thousands of dollars a day with ease, or pitching, no risk investments with guaranteed returns. Neither of these are reflective of reality. They're likely, very much likely to be scams. So it can be easy for an inexperienced young investor to fall for these scams, and be tempted by these highly speculative investments that, that's not suitable for the risk tolerance. I think it's really important for parents to emphasize to your children the need to be skeptical of what they see online when investing. It's a good way to protect themselves. There's a lot of wisdom in the saying, if it sounds too good to be true, it probably is. And I think having a sound investment plan and sticking to it may help young investors guard against the FOMO, the fear of missing out, and other temptations when researching investments online. And one habit that I found helpful is just try not to check your investments every day. You're doing it frequently, it's not going to serve you. I know it's just a little bit difficult for that because, we can have access to it, at our fingertips through our smartphones, through our computers, and we don't want to check it every day because we don't want it to lead us to do something that we will eventually regret. This can also lead to, if you're scared about something, you sell it, or you see something and you want to get in on it. That's really how people lose money. And not to mention, trading too frequently can rack up a lot of unnecessary trading fees. And of course, it's just going to push your investment plan. It's going to derail your plans, and ultimately, this will lead to
It's
regret.
certainly advisable to stay informed with your trading and make sure that you have a great idea of where your portfolio is at and where it's heading. But it's kind of like that checking versus savings account example that you were providing earlier. It's just nice to make sure that you can remove some of the immediacy of it so that you're not making more impulsive decisions which could be harmful like longer term. So let's say a child is ready to invest. What might their parent want to consider when they're opening up accounts for them?
So, a minor will need a parent or guardian to be named on any saving or investing account they open. So, I want to talk about brokerage accounts. So, basically, once a brokerage account is opened, there are several options to consider amongst the types of accounts that you can open: registered and non-registered accounts. So a registered account is one that carries, a financial incentive that may help investors grow their wealth. Okay, so the money invested within one of these accounts may be tax sheltered, or advantaged in some way, but they can carry some restrictions on how money can be deposited or withdrawn. So some of the common uh, registered accounts are the RSP, Registered Retirement Savings Plan, the Tax Free Savings Account, TFSA, and the Registered Education Savings Plan, the RESP. Whereas a non-registered account is a standard account that offers, no tax sheltering benefits. The investments held in it are fully taxable, but it will offer more flexibility on moving funds in and out of the account compared to a registered account. So, in my opinion, a parent might want to consider a registered account for their child because they offer an element of tax sheltering on the money within the account, which can potentially help it grow
Okay,
more
so let's
quickly.
keep that train of thought going. So, in your opinion, which type of registered accounts do you think might make most sense for children or teens in general?
I personally think a, a registered education savings plan, an RESP, may be worth considering for many children. It's a helpful way to save for a child's post secondary education because the federal government will match 20% of the contributions made up to a maximum of $500 per child per year in grant money. So a parent can open up an RESP as soon as the child is born, and they'll have and when they have a social insurance number. So as of 2022, the maximum lifetime government grant is $7,200 per child. Consider it free money. So basically, your child only needs to save $2,500 a year to max out the government grants each year. And they can reach the lifetime grant in under 15 years. And if that money is invested for 18 years, when many children start post secondary school, when they withdraw the money, they're going to be taxed on it. But the tax rate the child will be paying when accessing the RESP money would also likely be low, considering they're not going to have much of an income, if any at all. I also think a TFSA may be worth considering. So, a TFSA can be a great savings vehicle for long or short term goals because there are very few rules about withdrawals, and funds can easily be transferred to other accounts. I know this flexibility can help children who want to start investing but might not know exactly what their goals are just yet. And of course, to open up a TFSA, you must be a resident of Canada, you must have a SIN, and you must be at least 18 years of age. So if you do have a child under, 18 years old, the TFSA account will be held under the parent or guardian's name. And just to throw out there, as of 2023, a Canadian resident can contribute $6,500 in TFSA contribution room starting on January 1st of each year. And any unused room carries over into future years.
Now, to ensure that you're staying on side of all the many rules that the Canada Revenue Agency has, it's important to take some time to consult your local tax professional to ensure that all the rules and specifics have been interpreted correctly on your behalf. Now, there's a lot for a young investor to learn as they begin their investing journey, and it can be intimidating. However, TD Direct Investing has them covered with a ton of free educational content and resources available in the Learning Center that could help bring some structure to the learning process. So let's hop into WebBroker and take a quick tour.
The Learning Center is an extensive educational resource that's available to everyone right here within WebBroker. Whether or not you're just starting out your investing journey or you've got years and years of experience, there's something here for everyone to find value in. Let's jump in and take a look. Now, there are four main pillars to the Learning Center. We have our video lessons, our Learning Pass, master classes, and the webinars. Let's take a look at each one of these to get a little bit more detail. The video lessons, in this particular section, this is where we house all of our on-demand and timely educational content. You can scroll through and find something that might be of value to yourself. Additionally, you can filter that and find specific things that you're interested in learning about by choosing the filters option in the top right. From here, we can look at knowledge level, we can look at different platforms or account types, or we can dive right into finding particular investment choices or different strategy options to help make you a more informed investor. All right, let's jump back and take a look at our Learning Pass. Our Learning Pass are curated lesson plans that will bring you from start to finish and help inform your decision on a wide range of important investing concepts, from getting ready to invest to diversification, to managing your portfolio. You'll notice that these are a composition of multiple different video courses to master your proficiency in the area of your choice. Now, jumping back to the Learning Center, we're going to dive deeper into master classes. Master classes are something that are run by our client education instructors here at TD Direct Investing. We run them throughout each day and on Saturdays through a wide range of topics. They are 1 hour long sessions that are live, they're interactive, and they're quite engaging, if I don't say so myself. Jumping back to the Learning Center, we'll touch on webinars last but certainly not least. These are great learning opportunities where we go out to the market and find professionals in their fields and have an informative interview, but then also kick it out to a live question and answer period for where the audience can have their hot burning questions answered by these very intelligent folks. We have the opportunity to register for upcoming webinars, but also most importantly here, we can view and still continue to learn from all of our past and on-demand webinar content that's available here. Jumping back to the Learning Center, as we scroll down, we can see maybe which courses that we haven't yet to complete. But if we're still kind of maybe unsure of what might be important to us, and WebBroker does a really an interesting job of showing us some topics to help guide you down your own individual learning journey. There's some suggested topics based on courses that you've taken in the past. We also have featured content to keep you informed about new and interesting learning opportunities that we've brought into the Learning Center. And then lastly, we also have our popular topics. These are topics that are getting the most views from your compatriots in WebBroker, so you can continue to learn along with them and expand your investing horizons. Many different ways for you to interact and learn, all right here housed in the platform.
All right, Michelle, we're going to have to leave our conversation there. I'm sure all the parents in our audience appreciate your perspective on helping them work with their kids on how important investing can be. Before we wrap things up, let's reveal our answer to our trivia question. As a refresher, the question was, what percentage of parents are investing for their children's education using a registered education savings plan, according to data from Statistics Canada as of 2020? And the answer is about 58% of parents are investing for their children's post-secondary education using RESPs per Statistics Canada. That's up from just less than half back in 2013. The average amount saved within RESPs also rose to $14,520 at the end of 2019, compared with $11,429 at the end of 2013. What do you make of those numbers, Michelle?
That's great. I thought it was going to be a lot lower, and only because I never had an RESP, and then when I went to university, neither did a lot of my friends. So, so when I went to school, I relied heavily on student loans. But it's great to see that more than half of Canadians are investing for their child's post-secondary education.
I agree. It's nice to see the savings rates are up, but we're not done there. There's still room for improvements. Let's really take advantage of the program if you're eligible. All right. Thanks again for joining us, Michelle. And for those in our audience, make sure to register for upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. We'll see y'all next time.